Welcome to the introduction to the Ultra Portfolio, TRADEway's advanced and actively traded program. My name is Ben Russell. Today, I'm going to be one of your hosts along with Jenny Taylor, Jared Russell. We're going to be giving you an introduction to what is Ultra Portfolio, what do we do, and how does it work? One thing I do want to mention is we are here live with many of you. If you're watching the recording after the fact, we're welcoming you too. But if you're here live, well, that Q&A box is open if you have questions as we go. Now, what's today going to look like? Well, today what we're going to talk about, what is up? We're going to talk more about what that portfolio is. We're going to talk about why you may want to do it. What's the purpose? We're going to talk about what the Ultra Portfolio does, and then talk more about how at the end of the webinar, if you want to join, what would that process look like? Now, I'm a guy who loves puns, so if you haven't yet seen the pun, the AMPT Ultra Portfolio, we're abbreviating it as UP, the Ultra Portfolio. When you hear us say UP, that is the portfolio that we're talking about. All right, so everyone that's here today, I can see I've already got a few chat messages, so that's looking good. Hello from Minnesota and California. Good morning, everyone. We are so glad that you are here today. Fort Collins in the house as well. All right, so that chat box is open and the Q&A box is here as well. Excellent. All right, well, as we get started here with the rest of our presentation, who's our hosts today? Well, I'm Ben Russell. I'm the Director of Client Services in the AMP division. We're going to have Jenny Taylor along with us. She is one of our key investment advisors in the background. She's one of the IARs that will also be helping you if you decide to join the program. And then we've got Jared Russell. Jared Russell is part of our AMP program as well. And he is one of the active traders that's a part of this program. So between the three of us that you see here on this webinar, we're actually the individuals doing the work inside the Ultra Portfolio, the UP accounts that we're going to be describing with you here today. All right. So what is the Ultra Portfolio? Jenny?
Hi, everyone.
Ultra? What's this all about?
Yeah, so this has been in the works. This was in the works for a long time. And originally, we launched AMPT to be long-term investing, but we always wanted to be able to do short-term trading, very much like what we teach in the TRADEway education. So the Ultra Portfolio is simply what we're trading in and out of stocks and ETFs. It is designed to be a more aggressive trading and to use a portion of your overall assets to be able to be traded in and out, quicker trades, which we're going to go way more into detail about that in a little bit.
Awesome. All right. So this Ultra Portfolio, it comes as a concept where when Pastor David Mitchell built the AMP program, what he found inside of Ecclesiastes applies to what we're talking about here today. So I want to call out this Bible verse so you can see where are some of these concepts coming from. Now, this is Ecclesiastes 11, verses 1 through 2. Cast thy bread upon the waters, for thou shalt find it after many days. Give a portion to 7, and also to 8. For thou knowest not what evil shall be upon the earth. Now, what we see here is there is a diversification that comes straight from this passage that actually forms the foundation of much of what we do inside the AMP program today. But notice that also 7, that yea 8 is what David is often apt to say in his presentations. That 8th part is really where the TRADEway system comes into play, the active trading. And we really want you to actively trade up to 20% of your funds while preserving and growing the other 80% with safer methods. This is the AMP methodology in a nutshell. This is the statement of what is AMP. And Pastor David is fond of saying that yea 8 part, well, that's where things can get, a little spicy. That's where the opportunities for us to have some higher potential returns on a smaller amount of our portfolio comes into play. And that is why we created the Ultra Portfolio. See, we created this Ultra Portfolio to be that yay 8 part of the portfolio. We're putting in these active trading methodologies. We're getting in and out of individual positions. It's shorter term trades. It's designed to take higher risk with individual positions with a small part of your funds. Now, there is less diversification in this than maybe some of the ways in which we manage the AIM part of the portfolio. In AIM, you're going into sectors of the economy, ETFs that are broadly based across sectors. With the Ultra portfolio, it's designed to be targeted to individual stocks, things that we can see with a pattern, and that gives us the potential of potentially increasing the ROIs in this part of the portfolio. So how does it work? Well, most of the questions that we get, it's around the logistics. What does it look like? So, let's go ahead and talk about this a little bit more. Let's get into some of the meat and the potatoes about what do we do in the Ultra portfolio and how it works. And I think you're going to be surprised with all that has been built into this program. All right, so Jenny, you're one of the IARs. You get to do a lot with this program. Talk with us a little bit.
Yeah, so the first step is that you would have to join and be part of the Ultra portfolio. So that's where one of our investment advisory reps would meet with you to discuss that. And then you'd become one of our AMPT clients. At that point, how this works is our team is going to help you open up your brokerage accounts at the brokerage firm Interactive Brokers. At that point, once the account is open, approved and open, our team will help you with the funding process. So once the funds are there, we actually would then start trading your account. Now, you are granting TRADEway the discretionary trade authority for the accounts that you do open at Interactive Brokers. And then again, once the funds have hit, that's when Ben, Jared, and I take over and we start using our controlled trade sizes and our risk management plans for each and every trade that we would execute for the Ultra portfolio.
It's a powerful way, Jenny, to leverage technology and our expertise. And Interactive Brokers is a key part of our team's ability to do these services for you. I always like to tell people discretionary trade authority. What that means is that I can do trades in your account, but it's your account. You see everything that we do. I can't take money out of your account. That's only you. You're giving us discretion to trade, but that's it. And that's a powerful enablement. We're not taking custody of your funds. It's still a trading account. It's still in your name. You're just giving us and our tools the ability to make the trade in your account. Really powerful way to do it. So how are trades managed is one of the things that I get a lot of questions about. And they're more active. We are in and out of trades. And later on in the presentation, I'm going to be giving you some of the statistics from this first quarter of 2024. Well, you're going to see we were very active. And new positions, when we take them as a team, we're doing everything based off percentages. Pretty similar to what we describe in a lot of the trade management strategies that we suggest you as an active trader do. Well, we're doing those exact same things. When we add positions, we do it based on percentages of the account. And then each trader, each one of us, Jenny, Jared, myself, we have a portion of the portfolio that we can allocate to the trades, and then we are managing those individual trades with a documented trade plan. That sounds like exactly like what we teach you at our STEP seminars. Well, it is, because that's exactly what we do. Jenny, I get this question a lot. How are the trades communicated to our friends that are in the Ultra portfolio?
Yeah, that's a great question. So Interactive Brokers actually handles that for us. So at the end of each day, if there was an action taken on your account, and by action I mean if we bought or sold a stock or anything, a stock or ETF, then you would receive a notification or an email from Interactive Brokers letting you know that there was activity taken on your account that day. So that is how the trades are communicated. And then they have the ability to log into their Interactive Brokers account to see what trades they would be in. You can get quarterly statements from Interactive Brokers. So all of the same kind of ways that you would use a brokerage account, you still have access to do that. We're just the ones that are doing the trading for you.
And it's a powerful part of, we're using the tools to be able to accelerate us as a team. So what we do is we do the trades. Interactive Brokers is then helping us to communicate with you that there were changes made to your account. What does that let us do as a team? That means we can go focus on doing what it is that you want us to do. What do you want us doing? You want us trading. And that's what we're spending most of our time doing, is we are actively looking for the trades and we are actively managing the money in that accounts. So that lets us focus on the trades. Now let's get into that a little bit, because what I'd love to do is, Jared, awesome, good to see you, my friend. Let's go ahead and think through this. I think maybe our friends out there might like to see a little bit of the secret sauce that happens in the background. So you're one of our active traders. So if you don't mind, what I'd love to do, Jared, is I'm going to stop sharing my screen. And what I'd love for you to do is, can you walk us through maybe a couple sample trades? Show us kind of your thinking process. Show us what and how you're doing the management of the account in the background.
Yeah. Hey, everybody. Hey, Ben. Hey, Jenny. Welcome. Let me share a screen here. Give me one sec. And Ben, if you'll just let me know when you got me here.
Gotcha. Oh, I'm seeing charts by TRADEway, and CSX is up on the board.
Okay, yeah. So I thought, first, thanks for having me on. I think something that's important for everybody that's here is just to kind of, a lot of words and language get sort of thrown around in the financial industry. And of course, investing is a pretty broad term. So we have investing, and then we have trading, and we have active, and we have, passive, and all these words that get thrown around. And what, if you're anything like me, it's a little bit easier to see what we mean when we say we're going to be taking actions that we may be considered more aggressive, right? What does that actually look like, instead of us just saying that? Because you get this language of, long-term, short-term, aggressive, active, all these things, and you kind of go, well, what does that mean? Aggressive compared to what, right? And I think seeing how we operate in the different specific trades, a lot of you who are traders in our program will recognize a lot of this, but if you're not, just to show you an idea of, we're not just buying a stock we think is good and, we lollygag off into the future and we're not doing any management. This is not a long-term type situation. So I just wanted to show you a couple of examples of a couple of trade opportunities that I've seen in the last couple of months, what happened in those trades. And then, so that'll give you, instead of telling you, give you a visual representation of what this might look like. So here's an example on a company called CSX. It's a rail company, railroad transportation sector. And we can see pretty clearly on here, we had back where this blue arrow is, we had a really good trend. The chart was moving up. And so that blue arrow is highlighting an opportunity that I saw in the chart for a trade entry. So what that may have looked like and could look like on a kind of a rolling basis is, we're going to have, as Ben mentioned, a specific percentage of the account that I am able to allocate. I get to choose how much or little of that percentage that I want to put into the market. So on that day where the blue arrow is, it was a good opportunity from a risk reward perspective. So I bought CSX on that day. Now the red arrows, red usually is not good. The red arrows are actually, I'm showing you the first trade here, was actually one that I took off as a stop loss. So we bought it at the blue arrow, and I actually sold half of the position for a little bit of a loss on the first red arrow here. And then I closed the rest of the position for a little bit more of a loss on the second red arrow. And I think the takeaway from a broader perspective, Ben, is just that, and I can't help myself, I always have to do this, but is that when I take a trade on the blue arrow, like, I'm not going to risk a whole lot more than that, Ben.
Right.
It's like, we're okay getting out of trades with quick losses, cutting our losses short, so that when we start to let our probabilities play out over time as traders, the math works in our favor. So that was an example in CSX.
You know what, Jared, before you move on, can I just say
Yep.
something? I really think you're highlighting the power of what it is that we do in the Ultra Portfolio. You started off your presentation by talking about how you manage the risk. Isn't that kind of what you want in an active trader? Somebody who's not just going to look for only the wins, but is going to be able to control the expenses. Isn't that kind of the key to profitability?
It is the key. As a matter of fact, I think sometimes people think that forward progress in your active trading is you win a lot more than you lose. Well, that's great. That's great when that happens, but it doesn't always work that way. The key, as Ben just said, is really having situations where you're controlling losses, and then you're able to manage a trade based on the pattern, the trend, and your plan to have to have wins that outsize your losses, that outgain your losses. So we're, as a group, as a trading group here, we're never afraid to take a loss. It's part of what we do. The reason we do it is because we know long-term we can't build the type of success that we want to build on if we don't do that. Taking losses is part of trading, right?
Now, Jared, I can't resist the pun. Sometimes a trade goes off the rails, right? This is CSX, it's a railroad company. The key is how do you manage that trade so that when it does go off the rails, it doesn't affect the entire portfolio. That's a big part of what we do.
Yeah, and we didn't pre-plan that, by the way. That's just Ben being Ben. But I did for a reason. I wanted to show you the first trade being a stop loss because it is really the most important part of what any trader can do. So I just think that's reality. And just so everybody knows, that is our focus. My focus when I get in a trade is not singly or solely how much money I think it can make. It's first, where am I going to contain the risk here? It's the same thing I would do with my own money, my own family's money. The same with your discretionary accounts. We want to always control the risk. So there's one example in CSX. I have just one other to bring it, which is AMD. And I have some cues on here just so I can be quick here and not take too much of your time. But there was a few things at play here. We don't need to get into all the details of why I bought it, but the blue arrow is about the price that I bought AMD at. There's a specific pattern setup here that was kind of showing up, and I had been watching this chart. So right about where that blue arrow is was where I was entering buying AMD. And you know, sometimes the days and the weeks and the activity after you get in a stock really work in your favor, and sometimes they don't, as we've seen. In this case, just so happens that by the time I bought it, the market was hot, AMD was doing well, and the stock kind of continued to rise that day. And then the next day, you could see the first green arrow. It gapped higher and continued to rise. So it's not all that often that I am exiting a trade the next day. But in this case, the gain was significant enough based on the plan I had for the trade that I took off about half the position the next day, just because of the nature of what happened in the chart. I will do this often. If you're already in our program, you might see positions coming off a little bit at a time. I tend to like to do that. So I took off about half the position at the first arrow. And what that allows me personally to be more comfortable with the risk, right? So I'm always coming back to how I'm managing the risk in the trade. It allows me to be more comfortable. And again, if it's my own money, I want to be comfortable. If we're making trades in your accounts, we want to be comfortable with the risk. So I took off about half the profit here, half the trade for profit here. That allows me to loosen up a little bit, allow the stock to move higher if it wants to. In this case, it was a pretty fortunate few days. This does happen when you start seeing momentum in a chart. And I took off the other half of the trade right about up where that second green arrow is, which just turned out to be quite fortunate, right? We don't always, that doesn't always work out that way. But in this case, it didn't matter to me if the stock continued higher. It met the criteria that I needed. I took the rest of the profit on the second green arrow. Turned out to be a nice trade. And then as traders, it's our turn to just wait. And so that's what we do. We're waiting. We're looking at different charts, looking for different opportunities to find the same type of results, but wherever the stocks are setting up that meet our criteria. Generally, that's a TRADEway criteria. Specifically, Ben and Jenny and I may have some nuanced different metrics that we look for individually. But that was a good one on AMD. And we're always, man, if we could always just find charts like that, we'd be great, right? But as we've seen in our prior example, they don't always work out that way. But those are the two I have. There's a bunch more. Jenny's got a few, I think. There she is. And so just wanted to give you guys a little visual detail, you know, around a lot of the language that you might have thrown at you sometimes. And so Jenny, I know you've got a couple examples there. I'm gonna stop sharing. And I guess Jenny's gonna start sharing here. Give you a couple of her trades. So
Okay.
looking forward to it.
I guess I'll start too with the loser.
Yes.
Fence. Okay. I know. I'm just kidding. Okay. Let me share my screen here. No, hold on. I'm working off of 2 screens, so, but I don't really want to
Gotcha.
be looking sideways the whole time either. So, well, I just will be. How about I shut my camera off? There we go. Let me do this. I need to go back a little bit on this chart here. So, this was a trade that I did. Actually, both of the trades that I picked, I entered on 129, actually. So, there's a few things happening here on the chart, like Jared said. We kind of have without going into the details exactly of why I purchased here. I mean, we can clearly see it's bouncing up here. And I just, I had, it's been moving sideways, it's been basing. I thought, man, this thing could really, move pretty nicely out of this area. So I got in probably right around and through here. I do actually have that information written down, but I can't get to it because of the screens. So the very next day, it moved right sideways. Great. That's exactly what I wanted to happen. However, then the next day we have a gap down. So that got too many days there. It gapped down and then moved, in essence, pretty quickly right below where I wanted to stop out at. And this happened to also be Fed day. So when the Fed comes out, releases their minutes, and then Fed Chairman Jerome Powell always comes out and talks, and it can impact the market quite drastically one way or another. So it actually kind of hit a low, moved back up before the Fed announcement, and I decided to cut half of the risk at that point. So we may scale out to the upside, but we can also scale out our stop outs, which it gives us a little bit of flexibility. And what I was thinking there is, if after the announcement, the whole market just came and recovered, well, then it would have moved back up and kind of doing what I thought it should do anyways. Well, after the announcement, it ended up continuing lower and actually making new lows on the day. So I went and I sold the remaining shares of that one that day. And, when you're looking at the candle from that specific day, I mean, that thing could have easily went and filled this gap or even farther, right? So whenever we're, and we don't just do the trade and then never go and review our trades. Like, we're going back and we're studying our trades. We're looking at our profits, our losses, our ratios, and all of that, and continuing to try to hone our skills and get even better. But what's funny about this one in particular, but again, you can't know this, is looking at with hindsight, look, it did exactly what I wanted it to do. That, this is the exact move I was hoping to see happen from here, but then we just had this shakeout. The other one that I did the same exact day I bought was on this day. It had kind of moved sideways nicely and it was breaking out. And sure enough, it moved really nicely from the entry. I was able to sell it just a few days later. I sold half of the position here and then another half of the position on this exact day. So there was news that came out concerning the other one here. And it caused that gap down. Well, another one, the very next day, it actually gapped up. So that it was nice that we had some exposure even before the Fed meeting, because we did have some trades that worked well and others that did have stop outs. But that's where, again, Jared has already mentioned, this is all about probabilities, probability math, controlling the losses or expenses, and having larger gains than the expenses. And over time, the probability math works. And the other aspect of this is we're able to compound, which we'll talk a little bit more about as we continue farther.
Excellent. Well, thank you, JT. 2 great trades. Well, think about that. I just said 2 great trades. What's the definition of a great trade? trade done according to a plan. And that plan involves taking profits, and that plan also involves taking controlled stop losses. So really great examples from our traders of just 4 of the trades that we've done. So Jared, before there's a question here that's in play, that's in the window, I'd love to ask you about, Jared, if you don't mind. Do we do any bearish positions? I mean, we've talked about some bullish positions. Do we do anything in the bearish direction?
Yeah, we do. We have several tools we can use for that. Now, I would just say number one, generally speaking, remember guys, we're talking always risk first, right? We always want to control risk first. So the number one thing, we had a question about bear market. What happens if the market's really in a downtrend and those kind of things? And number one is well, back to the train tracks, right? It's kind of good to get off the tracks sometimes. You don't always have to be on the train. So the first thing we look at is, can we step out of the way of a market that's trying to run us over? That's always number one. But we do have tools to take advantage of down moves. We have inverse ETFs, where if markets are moving lower, we can actually buy. We don't have to short. We're not doing any of that craziness, but we can take advantage of instruments that actually profit as other instruments move up. And we actually have a recent example of one of those in the up portfolio, maybe if we want to touch on that later. But we do have instruments to do that. Again, inverse ETFs and some other interesting type of instruments. So Ben, if you want to do that now, we can come back to the specifics, however you want to handle that. But we can take advantage of downward moves.
Well, and I think it's really important to say as well, there's another question that came up that I'll answer it right here. Do we ever do anything other than just straight stocks? And the answer is yes. But I'm going to put a caveat to that. It's only for accounts that are above $25,000. It's in those accounts that we can actually do some limited options and spreads in. And part of that is a limitation of the tools that we have in Interactive Brokers. What we've discovered is that for the smaller accounts under 25,000, it doesn't easily distribute those across the hundreds of accounts. So we've simply chosen as a team to be able to make it to where the only time we do these more advanced strategies, spreads and things, options, puts, we're only going to do it in the accounts where the value is above 25,000. So that means that the values are under 25 would be in stock only positions. But we also do have stock positions that make money as those stocks go down. So we have inverse ETFs for the market. And Jared, you did one I thought was pretty interesting. You took the inverse of a stock that we all kind of know about. What was that inverse position that you took?
So that was Tesla a few weeks back. And there's some really interesting stuff that's available to us in the market these days. And in a handful of what you might know as the Magnificent Seven, your Apple and Amazon and Google and Tesla and some others, they've actually come out with inverse ETFs, where if I am bearish, if I believe Tesla price is likely to drop in the near future, I can, instead of actually using options or shorting the stock, which we're not going to do, you can actually buy. It's an estimation of the inverse of Tesla. So instead of shorting, we could just go buy the other thing, which we did in a bearish move that Tesla made recently. So we're always looking for new ways to take advantage of what the market's doing. And in some ways there may be some limitations, but overall continue to protect capital and grow capital in those moments in time where we feel like we have the advantage. So we have some interesting instruments to do that.
Yeah, and Jared, one of the inverses that I took, it's a stock that is the opposite of the Cathie Woods Innovation Fund. And when the market corrected a couple weeks ago, it did pretty well, right? So we do have capabilities of making money in a counter trend as well. And it's not just with options, but again, the team will do limited options trades on accounts that are above $25,000. So great question there. Thank you so much. And hey, Jared, I'm going to transition now and start answering some of the questions that our friends have already started putting in the window. How'd the team do? What's it looking like? What's the difference here between how maybe an AIM account is being managed versus the up? Well, we're going to talk with you. We're going to show you the number of trades. We're going to show that win-loss ratio, which is one of the key metrics for profitability. And then we're going to talk about what our monthly and cumulative ROIs look like year to date. And there's going to be some interesting metrics for us to talk about in that ROI number. So I'm excited to be able to show this. These are some of the numbers that many of you are very excited to see, and I'm anxious to show you. So let's go ahead and get into that. All right, there we go. So number of trades, this is for Q1 of 2024. We've done 116 trades in 3 short months. I think I told you that this was an active service. But is anybody surprised at the number of trades that you see up on the screen right now? 116 trades. Wow. From a win-loss perspective, that breaks down to 93 profitable trades, 23 expense trades, and some of those, well, we found out that some of our spreads were actually some of our larger losses. So there's a reason why we have often chosen to be a little less aggressive on the spread trades, and while we find ourselves kind of gravitating more towards the stocks. So let's see here. In January, we had 20 gain trades, 12 expenses. For those of you who are looking, yes, that's gains and losses. We just choose to, sort of make ourselves realize it's an expense in the trading world. February, 42 trades that were positive, that had a positive P&L. And then we had 4 that, well, there was a loss on that P&L. Well, that's a pretty good win-loss ratio there. We had a really good February. And in March, well, not quite as many trades as February, 31 gains and 7 losses. Those are some pretty nice stats. What does that come out to? Well, all in all, year to date, we're looking at an 80% win-loss ratio. What does that mean? Well, we are going to take those expenses. We are going to try to control those stop outs, and it is a key to success. It's something we describe to you in our active trading programs when we teach you. We say one of the keys to profitability is taking your expenses according to your plan. Well, friends, that's exactly what we've done. In January, we had a 62.5 win-loss ratio. All right, so we took expenses on trades that weren't working. February, 91.3% win-loss. February was a great month for us. In March, 81.5 of our trades, those were profitable trades versus trades that we had to take expenses on. And I'm with you, Carrie. That is a really good win-loss ratio. Well, so Curtis, you're asking me about the money. Well, instead of asking about the money, why don't we start talking about the percentages? Because the percentages are going to be about the same on all your accounts. What does that look like? Well, these ROI stats, instead of asking the dollar question, Curtis, let's talk about it in terms of ROIs. In January, we saw a 0.64% ROI. Now remember, we had quite a few expenses, but we were still profitable on the month. And in February, we compounded that 0.64. What does compounding mean? Hey, Jared, maybe you can help me with this. What do we mean by compounding? When I'm saying in January I made 0.64, why is it a big deal to talk about it compounding into February?
Yeah, well, it's just important to say, like you said, as you start adding up the numbers, you're like, wait a minute, hold on. I'm not sure these are all adding up. And it's just, it's the idea of whatever starting balance you start with. Let's say you take that and you've got this X amount of return in January, like we have posted here. Well, when you end January, if you end with a gain, right, you've got more money that we're going to be investing because we're allocating in percentage on a percentage basis in your account. You'll have more dollars in your account to start February, right? So then if you make a gain on that amount, you're investing on a bigger amount each month, assuming the gains are there. So the compounding is each month that you have a gain, you're invested with more of your dollars the next month. So as Ben has mentioned, and it is a key, we're looking, the equalizer there is percentage allocations, right? This is the safe way for us to control risk on a rolling basis, but still allocate relative to your current balance. So it's just taking one gain, and then the next gain is growing on a larger amount, even if by a little bit, and then the next gain on a larger amount. So those gains compound throughout the year or longer, as long as your funds stay in our account and we're allocating accordingly. Does that make sense?
Yeah, and Jared, it's a powerful way to describe why percentage allocations are the way that we do what we do. Think about January. If you started with a $10,000 account, And Jared, we often use like a 5% position is not an uncommon starting position size for us. A 5% position on a $10,000 account, that's a nice trade. But at the end of January, when I start February, I now have a $10,604 account. That means that my 5% position is slightly larger. And every month that my account grows, that default 5% size gets larger and larger and larger according to what the trade size of the account is. And it's a very powerful way for us as a team to help you to not only make money, but then reinvest those profits into the next trades. It's a powerful way for you and I as traders to be able to manage our money. And it's all done on percentages. Now,
Hey, Ben.
I do have to just go ahead, Jared.
I feel like I missed something earlier, and maybe you can tell me if I'm getting ahead, but I wanted to make one comment about remember how I talked about getting a little language around aggressive or conservative, and we had talked a little bit about that. Can I make one comment about that?
Oh, absolutely.
So when we say aggressive, remember how I mentioned we always terminology in the market can be so variable that we want to have clarity here for you folks. So when we say aggressive, I think you can see by the way Ben's mentioning how we allocate 5%. Some of you may say, wow, that's big. Some of you may say that's not very big. Well, aggressive is a subjective term, right? We have to have some sort of a plumb line that we judge against if we say aggressive. Well, we're going to be more aggressive. Okay, well, more aggressive than what? Right? So when I say more aggressive for our purposes here, let's compare it to something like a longer term retirement account that's holding mutual funds, for instance, where you may have one mutual fund, but it's going to own a huge basket of stocks and ETFs. And guess what? Some of those ETFs also own a bunch of different instruments. So you're very, very spread out. In the up portfolio, we may have, say, up to 10% of your account in a single stock. So a single stock, number one, has more single stock risk than a whole basket of instruments does. So it allows us to have that aggressive leverage or exposure to the market, but based on our own rules, we're still managing that risk according to where we're comfortable as an individual trader, and then of course as a group. So just wanted to give some language around that word that could be taken in a lot of different ways, and maybe just explain what popped into my head there. So thanks, Ben.
Awesome. All right. So a $10,000 account in January, I gained $64 on it. So now I'm trading on $10,064. That means a 5% position is bigger than what it was in January. At the end of February, you added approximately $400 to your account balance. Now you're trading on $10,450. That's the way that this works. And each month that we are able to compound the gains going forward means that when we do well managing our trades, we are more and more able to be able to fix the issues about how do we manage risk. All right, so are these returns net of fees? So the fees associated with trading, yes. So January, February, and March, these are the net gains in the accounts that we use to be able to track the performance. And I will call out that the past performance does not guarantee that we're going to be able to do this going forward. No trade methodology can say just because we did this in the past, it does not necessarily mean that we can do it moving forward. Now, that's also on the other side. You know, we could find ourselves in a position where we could exceed these numbers. This is trading, and you all know, you're traders, you recognize that there's times in which the market is very cooperative. You can have great returns. January was not a very cooperative month for us. You can see how because January wasn't very clear on the market tone, we didn't do very well in January, but we still had a profitable month. February, we knocked it out of the park. We were doing really well. Okay, great questions there. Thank you so much for that. So let's talk about the benefits of adding the Ultra Portfolio, the up to your trading, well, and to the services. It's a team of 3 people. It's not just one person, it's a team of 3. We back one another up. We help to be able to manage those trades. And it gives us the capability of being able to show how it is as a team, we do this together. A team of 3 people actively trading. We've all got a stop out plan documented. Our profit targets are documented, and we can help back one another up. Higher managed risk. Now, this is what Jared was talking about just a moment ago. Now, it's higher risk. Why? Well, because we're not as diversified. When you buy into a mutual fund, you've got small pieces of thousands of stocks. When you buy into an ETF, you've got small pieces of hundreds of stocks. We're typically in anywhere between 10 and 20 different positions. A normal position size is 5 to 10% of your portfolio in one stock. Can you see how in the financial services world that would be called a higher risk portfolio? It's because you're not as diversified. So by concentrating these allocations, you know what that gives us the capability of doing? Taking advantage of the very things that we teach you at our STEP seminars. Taking advantage of the moves that we see in individual stocks and trying to capitalize on those moves. And by doing that, it gives us the higher potential returns. You see, by managing those individual stock positions with great patterns, we have the capability of being able to discuss with you how those compounded gains with control bosses can really help to amp up your portfolio. And that's the other reason why we call it up. We're purposely designing this part of the portfolio to be the higher risk, the higher potential returns, to be able to have a little bit more juice, if you will, into the portfolio services that we provide you as a part of the TRADEway program. Now, I do see a comment here that there was a question about the returns. The fees that we charge you, which we'll go over those when you have a meeting with us, the fees that we charge are based on the size of your account. And the fees that we collect are done at the end of each quarter, the beginning of the next part of the quarter. So for example, we just took out fees on the first part of April for the first quarter. And those fees would depend on the size of an account that you've got as manager. Okay, let's see here. Let me make sure, is there anything that we need to cover before I move on to the next slide? Stan, we're an amped up. Do we need to work funds separately to be part of the Ultra portfolio, or how does it work? That's a great question, Stan. We break it up into different buckets of money, and each account is managed with a risk profile tolerance. So if you're in AIM now and you are not currently part of the Ultra portfolio, just email our team, ampt@tradeway.com. I would like to add the Ultra portfolio to my benefits. We'll help figure out what that looks like as far as what's an appropriate risk tolerance for you, working with your investment advisor representative, and we can add the Ultra portfolio to your benefits. It's just a matter of us duplicating your current account and moving the amount of money that you want us to manage more aggressively with the Ultra portfolio into that account. So you have a long-term account, your AIM account, that's managed by the long-term team, and then you would have a short-term, an Ultra portfolio account, and that would be managed by Jenny, Jared, and Beth. Great question there. Thank you, sir. What were the rates of return previously on average accounts? So anonymous attendee, I'm not exactly sure why you came in as anonymous. We actively started doing this last year, so we do not have a full year of results. I do know that our team has access to that. So if you wanted more information, send an email to ampt@tradeway.com and we can provide you those stats. I don't have them here on this presentation, and I would much rather have them documented as opposed to me talking off the top of my head. So because I don't have those here, I'm going to ask that you email that question in.
Hey, Ben, one thing on that question is, if through the end of it, I think part of that question is, are the returns that we're showing based on the full up portfolio or just the 25,000 and up accounts, 25,000 and higher? And the answer is those are across all the accounts. Is the vast majority of the profits came from stock positions, right?
That is correct. That is correct. Okay. Well, let's keep going, friends. So why investing with TRADEway is different? Well, I think maybe you've seen a little bit about why it is different. By us taking the trader's mindset, by us being willing to engage with you with the services that most financial advisors would not, actively trading in and out of stocks with our Ultra portfolio, we can bring to you and to our client base an opportunity to have those potentially higher ROIs with a smaller portion of your funds. And why we're trying to do that? Well, biblically, it matches with what we read in Ecclesiastes. We're diversifying with the AIM part of our portfolio across 7 different sectors of the economy. The goal there is preservation of assets in uncertain times. But then that 20%, that yay 8, that is where things can get very different. And if you'd like to know more, well, why not schedule a call with us? Myself and Jenny Taylor, we will be happy to be able to engage with you to answer your questions, to see if this is a good fit for you and for your family. Jenny, I'm wondering, do we have that poll question available?
Yes, I do. I'm trying to make sure I'm doing the right ones though. Yep.
Excellent.
Okay.
So let me explain what's going to happen is that for those of you who are here live with us, if you would like to schedule a complimentary discussion where myself or Jenny Taylor, we communicate with you and we start answering your questions about your specific situation and seeing that this is a good fit for you, the poll question that just appeared on your screen, this is an opportunity for us to have a direct conversation. And what we would like to know is just a little bit more about what are you looking to potentially invest in the Ultra portfolio. And the reason why is that you'll see in our discovery call that the fees that we charge you will be based on the amount of money that you're asking us to manage. So when you give us that amount of money, we'll come prepared to that conversation to help you to understand what your fees are. Now, Jenny, is there an upfront cost for this as well? There's a small upfront cost, right? What is it, like $400?
Yeah, there is. So we would discuss all of that and what discounts that we would have available as well. But Ben, I kind of think that maybe because this actually has a second question, kind of which ones are you interested in, right? And our long term, our short term. So, and we did have quite a few people. Well, I've heard of AIM or Pro. So I'm just wondering if you can kind of give a brief summary of what we offer through AMPT as well as not just the Ultra portfolio. Because some people might be interested in and maybe also having us help manage their long-term funds.
Yeah, absolutely. And it's a really important call out that I've described how the Ultra portfolio is designed to be for that 20% trading money. Well, some people are like, hey, Jenny, I'm learning how to trade myself. Why should I have you guys manage it? Well, maybe you're still in the learning phases, or maybe you're not yet at the point where you feel like your skills are at the point where you want a large sum of money to be in the market under your management. Well, why not let us as a team help you with that? That's your 20% active trading money. But what about the other 80%? Wouldn't you want it to be put to work as well? Well, that's what the other part of our services are designed for. The AIM program is long-term. We as a team manage the funds for you, diversified across sectors of the economy and very centric on what is the news and the market tone. The long-term team looks at market tone as one of the key primary decision makers. And what we're going to try to do, we're going to avoid those really big hits that come when those bear markets hit. 2008, 56% decline. Our portfolio management style is to avoid those big hits so that when you get on the other side of that bear market, you've got a lot of your capital to deploy in the next bull, which is where most of the money is easily made. So that's our strategy. Now, what if you wanted to do that yourself? Well, instead of us pressing the buttons in AIM, you could press the buttons yourself in what we call the Pro program. Now, the Pro program's got a little bit higher startup cost because our team has to teach you how to use our tools. And we'll do that. We'll show you how to use the Trader Workstation from Interactive Brokers. We'll show you how to use the allocation files. And then as a Pro client, we would tell you when to take action and which CSV files to go to apply. And that's kind of how our services come together. 20% active trading, that's our team doing it, or you doing it. 80% longer term, AIM, we're pressing the buttons. Pro, you press the button. Okay. A couple other questions that are here. I have an account, but I'm unaware. So all you need to do is if you have an account with us and you want to add the Ultra portfolio, just email in and your investment advisory representative can help you with adding Ultra portfolio to your current benefits. Will I be able to do trades myself with the same amount used and up? Yeah, so sorry, if that's what you choose to do, your trading money and how we actively manage is different. What we would suggest is that between your trading and our trading, you probably still want to stay within those 20% allocations. So what's your net worth? Look at the assets that you have, determine what that net worth is. We're suggesting you want to stay under 20% being actively traded in the market at any one time. Now, there is a reason for that that maybe isn't intuitive, right? We talk about trading with TRADEway. Why is it that we're asking you to not trade 100% of your money? Well, what happens if there's a 9/11 like that? Right, so you don't want all of your funds in very aggressive or actively traded accounts where those accounts could get drastically hit by what we call a black swan. Your 80% money is designed to be more diversified and more able to sustain a black swan event, so that on the other side of the black swan, you still have some money with which to be able to recover. Fortunately, they don't happen very often. But if you had all your money actively and very aggressively invested, you could have a very bad day in a black swan event. That's why we suggest it that way. All right. Can we invest the Ultra portfolio from our business accounts? Absolutely. Absolutely. In fact, it's one of the ways that a lot of our traders take advantage of our services. As a business, you have to pay some fairly substantial market data fees to get active market data on your business account. Well, we're professional traders. We pay those fees because I'm paying the fee for my market data. It means I can use my market data as I'm managing your account. Great question. What's the definition of long term? Most of the positions that we take in the AIM position are months to multiple months long. Usually that is the definition of long term. So usually about 3 months to 6 months is a normal long-term position. And in the AIM part of the portfolio and the Pro, that's what you can expect to see, multiple months in positions. In the Ultra portfolio, you see we're in and out of positions all the time. So great question. Any other questions there, Jenny, that maybe we need to talk about?
Not that I'm seeing, but the idea of can we help with a business account? Why don't we touch a little bit more on the other types of accounts that we can.
Awesome. No, that's a great, I'm glad you mentioned it, Jenny. So can we do more than just business accounts?
Yes. So we can help with pretty much every type of IRA account, meaning Roth, traditional, inherited, SEP IRAs, as well as people that may have maybe an orphaned or an old 401k. We can help with that. You could have to roll that over into a traditional IRA. But also sometimes people can even roll over their current IRAs. They're not IRAs, their current 401ks. They would just have to check with their benefits administrator about that. But those are, when we have our consultation with you, we'll talk through all of the different types of accounts that you have, to see if that is something that we can service. So I know somebody had asked about an annuity, so that's why we have to have these consultations to discuss your specific financial situation, the specific accounts that you have and all of that. So
it's a great call out, Jenny, that I see several of our friends asking about some specific situations, and the answer is going to be it depends. But I will tell you one of the primary things that I see a lot of our friends do. You have like 4 or 5 different 401ks or IRAs from previous employers, and you've just got money all over everywhere. A lot of times what will happen is you'll come into the Ultra portfolio or the AIM portfolio, and our team, our client engagement managers, those are the people that help you with getting your accounts created. They're really good at helping you to get those consolidated and cleaned up. So if that's you, you're sitting there and you go, I've got so many different accounts in so many different places, I don't even know what my money's doing. Well, this could be a great time to leverage our services and let us help you with that cleanup effort. So a very powerful way for us to be able to help you as well.
And let me just add, so we do have to manage those accounts at Interactive Brokers. We can't be managing your account at the current broker that it is at. So like Ben said, we would help you. Well, he kind of mentioned it, but I mentioned it a little bit earlier. Like, we'll help you open all of the different accounts that you may need or that you have that you're wanting to bring over. And then we also help with the funding process. So that can be kind of a little bit intimidating. So we have a staff, a group of staff members that help with just specifically with funding and account setup. So you do have to bring the funds and the accounts over to Interactive Brokers. And again, when you're bringing over IRAs, we're opening IRAs. You're not going to have a taxable event just from bringing your IRA money from some other broker to this broker. We're going to keep that as retirement funds, and where it's not going to be a distribution to bring the funds over.
Excellent. So the question here that I want to follow up on that is often what we do, Jenny, is we're going to help our friends to be able to determine, can you roll it over? What does that rollover look like? What's that process so that there are no tax consequences to those rollovers? That's a big part of the service that we do. Okay. Were the returns shown earlier total account returns? Yes, Mitch. They were total account returns. And then there was a question earlier, are we investing the entire account? We're very rarely fully invested. Very, very, very rarely do we have 100% of your trading money in the market at any one time. Last quarter in February, I saw the peak. We were about 85% invested. And at times in which the market is really unknowable, we don't know, we're very nominally invested. So those returns that you saw were full account portfolio returns for the month.
Yep. Yep. And that's really, that amount is really going to shift based on have some of our trades moved up and now we're taking profits. And then we might dump 30% of the stocks that were the stock 30% worth of stocks in one day because we booked profits or we had to stop out of some. So then that's going to adjust for that day. And then we're looking, we're either looking that day or the next day, or we're just constantly looking for the next opportunities. So the amount that you have in cash is really going to fluctuate not super drastically, but it's going to be a fluctuating number kind of throughout all the time. Because we're always looking for new trades, we're always managing the current ones, we're buying, we're stopping out, we're selling for profits. The amount that's in cash is going to change.
Okay. Well, there's been some great questions here. What I will say that some of the other questions about how the Ultra Portfolio versus the AIM program works, I do have a video that if you wanted to see how our AIM services and our Pro services are functioning, we could send you a video on that. That's not necessarily the topic of today's webinar. What I'm trying to do is be able to get an Ultra Portfolio video so that you all can see exactly what happens in Ultra. And then I also have AIM videos so that depending on what your questions are, I can answer those specifically and in a very targeted way. Last question, do we think a recession is coming? We do still think a recession is coming. The question is the timing. So what we're going to be doing is managing around the charts and that market tone, specifically in the Ultra Portfolio. And the most recent advice that we've given to clients is we probably won't see a recession until the Fed starts to lower interest rates. So it's one of the key metrics we'll be watching for. Okay. Well, Jenny?
We had one more question here. So Erica asked, the compounding idea is great, but how long does it take to get people's funds out if they did want to take a withdrawal?
That's a really good question. Here's what I will say is it depends on how much. I tell my clients all the time, if you're taking out 5%, not a big deal. You can pretty much do that almost anytime you want to, and you don't even necessarily have to tell us about it. If you're going to start taking more than 10% of your account, you're going to have to let us know so that we can close out some positions. And then there's typically a 3-day settlement time before you can actually remove the account.
Yeah.
Is there an e-brochure we can review prior to the consult? Yeah, absolutely, Dave. So what's going to happen is that when you request an appointment, when I do it, I send you my link for a calendar invite. And that calendar invite also includes the ability to schedule at your convenience. But that introductory email also includes what we call the AMP story. That is the e-brochure that you're asking about. So when we schedule an appointment, Well, we also send you that brochure so you can review it. And you've got the capability of coming to our session together with a little bit more information about the program. Glenn, the Insider Plus and Trader Max subscriptions do not apply to these services. Those are trading things on your own. So you're learning to trade with Insider Plus and Trader Max. These services are us doing the work for you. So they do not apply to Insider Plus or Trader Max memberships. All right. Well, I think we did a really good job of getting through a lot of great information and questions. If you have additional information or questions you would like to have, well, why don't you go ahead and reach out to us? Go to tradeway.com/amped, or you can email us at amped@tradeway.com. Opportunities for us to be able to help manage your money. This is a really interesting program. I don't know of any other financial advisors that are doing it quite this way. What you've seen today is exciting to you? Well, we'd love to have a conversation with you. Either email us, let us know that we'd like to be able to schedule an appointment. And Jenny and Jared, thanks for being on today. It was a lot of fun hanging out with you and answering some great questions.
That was great. Appreciate everybody coming. Thanks for heading it up here, Ben.
Yep. Thank you. And thank you for everyone joining. We're glad that you took an hour of your day to join us. We know that that's, our time is precious. So we want to make sure we bring you good information, and we thank you for joining us.
All right, everybody. Thanks for being here. We'll see you again soon. Thanks for being on. And if you have signed up, be watching that email. Sometimes our emails go to your junk mail. So please make sure to scan that junk mail and set up an appointment. We're looking forward to telling you more about the program. Bye, everyone.